Hey everyone, it's Thursday morning, February 19th, and welcome back to Capital Markets Quickie. I'm your host, Endrit Sella, here to break down yesterday's market action in just 2 minutes. Quick note before we dive in. Today's episode is brought to you by AMF Capital, Asset Management Frankfurt. Learn more about our funds and strategies at amf-capital.de. Alright, let's get started. So, US stocks edged a bit higher as some of the recent artificial intelligence fears cooled off, and investors took a closer look at the latest minutes from the Federal Reserve. The Standard & Poor's 500 added 0.6%, while the tech-heavy Nasdaq Composite climbed 0.8%. The Dow Jones Industrial Average, which has less exposure to tech, also moved higher, up 0.3%. Now, technology stocks were clearly finding their footing again after a pretty rough stretch. Software companies in particular had taken a hit recently, so yesterday felt a bit like a reset. That said, investors are still thinking carefully about the bigger picture, especially the long-term impact of artificial intelligence on business models, competition, and whether all these massive investments will actually pay off. Meanwhile, attention also turned to the minutes from the Federal Reserve's January meeting. Those minutes showed a bit of a split among policymakers. Some leaned toward keeping interest rates steady for now, while others suggested that rate cuts could be on the table if inflation continues to move lower. According to the minutes, several participants said that further downward adjustments to interest rates would likely be appropriate if inflation declines in line with expectations. Markets are currently pricing in at least 2 rate cuts this year, and the latest Fed signals didn't really shake confidence in a possible cut by June. So overall, a calmer session for stocks, a pause in the AI panic, and a Federal Reserve that's still keeping its options open. Alright, that wraps up today's Capital Markets Quickie. Join me again tomorrow morning for more market updates. See you then.